What a difference a year makes. 1 year ago, mortgage rates were just below 3%, and today they're almost double that. An add-on $400,000 home. Borrowers are paying almost $700 more a month than they did last year. And a new wrinkle here, the value of people's homes is actually starting to go down. Let's get to Diana Olick with all the details. Diana.
Well, Melissa, you're seeing refi demand way down because there are about 12 people left who have rates under 6%, like you said. And you're seeing home buyer mortgage demand down because higher rates are pricing buyers out. And that is finally having an impact on prices, which dropped 0.77% from June to July, according to Black Knight. That might not sound like a lot, but it was the first monthly price drop in over 2 years. Roughly 85% of major markets have seen prices come off their peaks through July, with 1/3 coming down more than 1% and about 1 in 10 falling by 4% or more. So after big price gains, some homeowners are now losing some housing wealth. So-called tappable equity, which is the amount you can borrow and still keep 20% equity in the property, hit its 10th straight quarterly record high in Q2 of this year at $11.5 trillion. But May was likely the peak. Total tappable equity is now down 5% so far since May. And Q3 will show a more sizable decline. The biggest losses are, of course, where prices were the highest in the West, like San Jose, Seattle, San Diego, San Francisco, and L.A. But I do want to make this clear. This is nothing like the Great Recession, when home prices crashed dramatically and millions of borrowers went into foreclosure. Melissa, nothing like that.
The loans are very different from what was made, but we're also in a different just supply dynamic, right?
Yes. I mean, the loans are much more responsible. People have to actually be able to afford the payments the way they're underwritten today. And yes, there is still strong demand in the market and low supply, which will keep a floor under prices.
All right, Diana, thank you. Diana Olick. What do you do with home builders, Steve?
Well, you just said it's a supply-demand issue. How many people bought a second home during the pandemic? Right? How many people are still holding that second home and they're watching their payment double? So you haven't seen the hurt yet until you really see the pain when rates rise. Then you'll see a supply really affect it when you see these houses being put on the market for sale.
Does this all not affect a Home Depot or Lowe's?
It does. And I think certainly home equity values and what is tappable. Ultimately, I just think you have a dynamic here with home improvement where people are actually, if they're not moving around, they actually may throw more money back in their homes. But Home Depot and Lowe's, Home Depot more than Lowe's, the resiliency of the professional business has been part of the margin expansion of the company and part of why it's been trading at a premium. Lowe's trades in a market multiple, I think more attractive than Home Depot here. These are names. Home Depot at 250, though, which we're a long way away. But that's the level you started nibbling at back at those June lows. That's the level to watch.
You throw money back into your home unless you're throwing money into the grocery store instead. I think that's the problem. I mean, food prices, gas prices may come down. Food prices are still elevated. People, companies are not rolling back the price increase on Doritos, just for an example, because commodity costs have come down.
You see, you say Doritos, like you've never had a Dorito in your life.
Yes, I have.
You like Doritos?
Cool Ranch.
Cool Ranch. Wow. That's probably the worst flavor.
Thank you, Tim.
No, I mean,
I like the original.
I shouldn't
Actually, I've never met a Dorito I haven't liked.
That was mean-spirited by me.
Anyway.
Again, more you know. So I'm going to try to connect a few dots here, which is typically something I do. It fails miserably, but I'll give it an attempt here. I think it's just as easy as trying to figure out where interest rates are going. So look at the low of TLT today. Look at the bounce in TLT. Pretty much the same low we made in the fall of 18. I think TLT goes higher from here, which means interest rates go lower from here, which means a name like DHI, which I happen to think is the best home builder, which traded up to 110 down to 60, now 72. You can buy, especially if you think rates are headed lower, which I do.